Excuse me. So today is Wednesday, April 23rd, 12:30 p.m. section. This call is being recorded. As we get started, before we talk about homework 12, any questions about anything? All right, well, again, let's do a quick check-in on the Bloomberg Trading Challenge. So we are today. Stocks have been on pretty much a big up and down roller coaster here last couple of weeks. Start out with section 101. So if you're watching on video, here is current rankings. Again, make sure that you do 10 longs by the end of trading, which is coming up in a couple of weeks. So here is the relative ranking today of the markets. We see one team that's actually a positive return, but again, it's been rough riding in the markets. Section 201. It's this section. Again, this team, make sure you do 10 longs. Do at least 4 more trades over the next couple of weeks. Section 301, it's 2 p.m. And these 3 teams, make sure you do your 10 longs. And finally, section 401. There's not the 10 long threshold there. All right, again, those were the kind of current rankings of the trading challenge. Questions about the trading challenge? All right, so looking ahead of the calendar, 2 weeks from today is your final presentation day for the class. And that's going to be on multiples. I'm just giving you a heads up. It will also be, for many of you, our final class. So as we think about end of semester logistics, what that presentation is going to be is you are going to take the company you did your valuation presentation on, and then you're going to select 3 peers within that industry, and you're going to do a multiple analysis on those 4 companies. Okay, so I'm going to let you choose who are the benchmark peers for your company. So for example, let's go back to Bloomberg here. Let's say that you were doing, I don't know, Lilly or Merck. So you go to Lilly, RV, and again, you can choose whether or not you want to use the analyst curated or the BICS. Okay, so you use one of those 2. And again, you want to decide whether it's global or local. For pharma, I would probably say global would be a reasonable peer list. So basically, you would take Lilly, pick 3 more companies off this list, right? And then you would do the multiple analysis as of that time. So that's going to be your final project. 10 minutes. You're going to explain the premium or discount of your company against each of the 3 others, PE, EV to EBIT, EV to revenue, right? Which we'll practice talking about today in homework 12 and one more time in homework 13 for Monday. So that is coming up. And again, in that 10-minute presentation, by the end of the fourth presentation, everyone in your team should have presented over the course of the semester. Okay, so if you have 7 or 8 people, we told you to spread it out, but by the fourth presentation, everyone must be in front of the room presenting at least one of those. So if you haven't previously presented, you should be making that presentation 2 weeks from today. Okay, so as we think about end of semester logistics, we just kind of go back to ELMS, remind us. So in terms of coming up assignments, homework 12 we'll talk about today. Homework 13 is due Monday. So just to be clear, I know it says extra credit on it. It's still a mandatory assignment. Okay, so for purposes of opting out of the final exam, you have to complete homework 13. Why I'm calling it an extra credit assignment is that we are now beyond 100 points available for the class. And so these points are part of your grade, but there's now more than 100 eligible points to get your grade. Matter of fact, with that assignment and the other extra credit points that I had given, there's now potentially 104 points total that can be earned this semester. So I'll again warn you that ELMS gradebook was never designed to handle that and can be a little bit misleading because the ELMS gradebook does a percentage of total, right? And so in this class, as I said, to get an A, you need 93 total points. So 93 divided by 104 as a percentage is less than 93. And that's what ELMS will show you, and that will not be your grade, right? So you need, across all the assignments, exams, group projects, add up the total points out of 104, 93 of the points equals an A, 90 points equals an A minus, 87 points is a B plus, 70 points is critical of passing as a finance or accounting major. Okay, so that's the minimum amount of points to get a C in this class. So that's what's going to be happening. And I will also let you know, since I'm giving you 104 points, that there is no rounding. So if you are going to look for the best grade you can, make sure you complete all of these assignments. The other assignment that can help you, because I've gotten some questions about this, is the assignment replacement, which is what is it? I put it in here. Got to make it visible. But the assignment replacement. All right. Oh, there it is. It is due on May 5th. So the idea is that for this assignment replacement, kind of right here, it's on the extra credit assignment, 2 people have already submitted it. You write a paper, 500 words on this topic, okay? And essentially, if you do that, then what we will do is we will take one of your individual assignments, which could be any one of the 13 homeworks or potentially even the Bloomberg certification, and we'll replace it with a full grade with full credit. So for example, let's say for some reason you didn't do homework 7 and you got a 0, didn't turn it in or didn't turn it in on time. If you do the homework replacement, then we'll treat homework 7 as if you turned it on time. We'll give you 2 points and it won't impact your ability to opt out of the final exam. Okay, so we will choose which assignment is going to be replaced. So the TA will do it. You can talk to them about which one you think should be replaced, but they're going to actually do the replacement. And what they're going to look for is either something that was a 0 or something that has the biggest delta between the lowest score and the total points available. Okay, but generally they're going to replace assignments that you missed. So what the homework replacement can do is it can replace any one of these 13 individual assignments. It can replace the Bloomberg certification. Hopefully nobody has to have that replaced. or it could replace a missed peer review. So for those of you that didn't turn in your peer review on time or did not turn it in or had a problem with it by deadlines, and you got a -1, and you did all the other assignments, if you do the assignment replacement, that can replace a missed peer review. And so that will give you a 0 instead of a -1, and it will make you eligible potentially for opting out of the final exam. Because if you miss a peer review and you get a -1, you can't opt out of the final exam. What the assignment replacement will not replace is any group project. Okay, so it won't affect any of the group cases, and it won't affect the Bloomberg Training Challenge, and it will not affect the midterm exam. Okay, so it doesn't affect exams or group projects, but it does individual projects and our peer reviews. Does that make sense? Questions about that from anybody? All right, so then just one other word about timing. So again, what's kind of coming up on the calendar, Monday, the 28th, homework 13. Monday, the 5th of April, assignment replacement is due. Monday or Wednesday, the 7th of April, you'll do your 4th group project presentation in class. Again, 10 minutes, similar to the others, covering your company plus 3 that you select as peers based on the company that you did your valuation on. I would actually select easy peers. So don't select the peer that's impossible to explain. There's a big universe of peers that I'm giving you opportunities to think about. So take advantage of things that are at least calculatable. And then what's going to happen is on the 8th, the final peer reviews are due. On the 9th, all grades will be in, and the TAs will apply the opt-out criteria. Then sometime on the 9th, you'll get an email that basically says, check ELMS to see if you can opt out of the final exam. If on the 9th, you were told that to check, what you're going to check is the final exam opt-out points. If you're able to opt out of the final exam, you'll see 10 points next to your name because you're given the 10 points for opting out of the final exam without having to take the exam. Okay? If when we tell you to check on the 9th of May, you don't have 10 points, you have a 0, that means on Monday, May, that date is that, the 12th, you will take the final exam for up to 10 points, right? So if you opt out, you're done. You don't have to take the exam on Monday, May 12th. If you don't opt out, then you take the exam Monday, May 12th. It'll be a 10-question multiple choice exam, similar to the midterm exam that you'll take Monday, May 12th during your class time that you're registered for, unless you have an ADS accommodation. If you have an ADS accommodation, you will take it sometime that day, May 12th, but otherwise you'll take it during class time on May 12th. So for your class, your section, if you're taking the final exam, the exam will open at 12:30. It will close at 2. Right? 10-question multiple choices. So just kind of covering some end of semester logistics for purposes of planning. For all intents and purposes, your last live class will be Wednesday, May the 7th, which will be 2 weeks from today, which will be the final presentation day that we'll be making. Semester is quickly coming to a close. All right, well, if no questions, then let's talk about homework 12. So we should all have numbers fairly similar to this because I gave you the screenshots and we started developing some of this during class. So first question, your numbers look similar to this. They might be slightly different in ROEs and Gs, but nothing dramatically different. You might have like 3.2% negative 3.2, not negative 3.1 for target, but you shouldn't have like -4, -5. Your numbers should be fairly close to these numbers. So the question to the group is, do you have any questions about any of these numbers? Where they came from, how we got them?
I got one question.
Talk about what they mean in just a second. And again, here is the second tab, which has the operating ratios.
I got a question. Can you hear me? Can you hear me?
Okay, well, assuming you got the numbers, let's talk about the analytics. So for the first part of the analytics, we're basically answering, starting with the price to earnings multiple, right? Why is Costco trading at a premium or discount to Walmart and Target? Okay, so we'll start out with Costco versus Walmart, right? Costco's PE of 47 is much higher than Walmart's PE of 31, which means Costco is trading at a premium to Walmart. Walmart is trading at a discount to Costco, language that we would use. So why is Costco a premium? Why is it higher? Right? Well, these are essentially going to be the key reasons for the PE, right? So the first one is the spread. Costco clearly has a higher spread than Walmart. Costco's ROE, expected ROE of about 26% versus a cost of equity of 8.5%, okay, is much higher than Walmart's expected return on equity of 22% against an 8.3% cost of equity. Okay, so Costco has a spread that's about 4 points or 400 basis points higher than Walmart long term. That should lead with the key value drivers to higher PE. In addition, Costco's G is almost 7% per year, 6.95, and Walmart's G is 5.95, or about 6% a year. So Costco has about 1% more compounded growth per year at that higher spread. And that's the primary reason why Costco is trading at a much higher multiple than Walmart. It's very, very straightforward, right? I'm basically paying more for higher growth, higher spread. Remember, higher spread is a proxy for cash flow. ROIC is a proxy for cash flow. And I'm growing that cash flow at a faster rate consistently at Costco. So the other aspect of this is risk. And their cost of equities are pretty similar, 8.5% at Costco, 8.3% at Walmart. Walmart is a slight advantage from a discounting standpoint, so that's helping them, but not nearly enough to offset the lower growth and the lower spread. And again, once you start getting higher spreads, growth becomes dramatic when it comes to multiples, right? So that becomes really key to why the multiple is higher at Costco. It should be relatively straightforward. Hopefully that's what you were writing up in your papers. Again, questions about that analysis. Costco versus Target. Target is trading at a discount to Costco. Costco's PE is 47.25, Target's 9.9, 9.89. Why is Target trading at such a discount? Why is their PE so low, right? Well, they actually have pretty high spread. Target spread, 26% expected ROE against an 8.2% cost of equity. It's very close to Costco's. So Target and Costco have very, very similar spreads, right? The difference is the growth. That Costco is expected to grow 7% a year. Target is expected to shrink about 3% a year. Okay. So this gets back to, is that a reasonable level of G? Is -3%? Brian, you had a question?
Yeah, can you hear me? Can you hear me? I don't think you hear me.
Brian,
Yes,
are you on mute? Not hearing anything. Did you have a question?
Yeah. Can you hear
Did
me?
you accidentally hit the hand raise by mistake? Oh, hold on. It might be my problem. Let me check one thing. All right. Sorry, Brian. Ask your question again. I think that was my fault. I had my speakers on mute.
Can you hear me now?
Here you go. That was my problem.
Oh, no problem. Perfect. I had a question about the target G.
Yeah.
So I remember the last X, I think it was Delta, where you basically told us not to, when we get to a case like this, to
Yep.
go seek ROE instead of go seeking G when it doesn't make sense. Is this one of those cases?
That's a great question. That's what I was actually leading into. So this gets back to, and there's a little bit of an art to this, but it gets back to, can we explain this? So when Delta had a negative G of negative 10% a year, that was hard to explain because the way to think about this G is this is a G in a perpetuity. That means I'm compounding a 3% loss every single year into perpetuity. Okay. And so the question is that what's happening with Target? Like, does the market think that Target's best days are behind them and that they're going to struggle on a go forward basis? And so you could argue with that PE of 10 versus the PEs that are much higher for Costco and Walmart, that Target is expected to struggle, right? Because people just aren't paying a lot for Target right now. Now that could be just because of the nature of the environment that we are in. And people are kind of overselling Target in the short term, meaning as people worry about pricing, originally inflation, now in tariffs, and as consumer confidence plummets and people are starting to worry about where they're spending their money, we know historically that people tend to trade down. Okay, that's why companies like Costco and Walmart tend to overperform in bad markets versus other companies because people are trading down to the discount retailers as opposed to the more luxury good retailers. For example, look at LVMH recently, and what you're going to see is that their stock has been under pressure because people are not buying the $2,500 purses at the same rate that they used to be with the Louis Vuitton purses, or shopping at Tiffany's nearly as much because times are tougher. And so is that what's happening with Target, who used to be called Target by the younger generation, but the idea is, are people trading down, and is that the way the market is trading Target? So that's where the negative 3% comes in. Now, that's one story, and I think I could sell this one more reasonably than I could the Delta, like the negative 3%. If it was negative 7%, might be harder to sell. That's why I said it's a little bit of an art form as to where you think the math works out. But could you have done it a different way? So let's go back to the original question. So what, if you did put in a growth for Target, what growth would you have used? Or did you use? Like, how fast do you think Target's going to grow long term?
I would have used 3%.
Okay. So we'll, instead of negative 3, we'll flip this to positive.
Yeah.
Okay. Well, first of all, with that spread, if they're growing at 3%, their PE would be essentially double. Okay. So they clearly can't have that spread with any reasonable level of growth. So in order to figure out what the spread would be, you probably could have goal seeked. And if we goal seeked, there it is. It's hidden over the side. So if I set this to 9.89 by changing the spread, then what it says is at 3%, then the market's expecting a negative spread for Costco launch. Is that about the numbers that you got?
Yeah. Yes.
Okay. So in common language that you're explaining to a non-finance major, what's the story of that? What would you say? How would you explain that?
That they have a negative spread of I think a little bit under -2%.
Yeah, but why? Why do you think they would have a negative spread long term? What would be the business rationale for that?
That on the long term, they're not, their returns is lower than the cost of their equity in the long term.
Okay, but why? Why would the returns be so low long term versus where they are today?
Uh,
What would cause those returns to go down?
well, those sales could die because of the current economic, um,
Well, but if the sales are dying, they wouldn't be growing at 3%.
right.
Because you're saying it's growing at 3%. And sorry for the questions, but I'm not questioning your rationale. What I'm just saying is you got to have a consistent story with what you're saying and representing in the numbers. So you're actually saying they're still going to grow, but their spread's going to go down. So if the growth isn't the reason for the lack of spread, what's causing the returns to go down?
Somebody in the chat say higher cost and due to tariffs.
And if they have higher costs, that means that they're getting lower margins, right?
Yes.
So your version of the story is that long term, the market's expecting targets margins to dramatically decrease.
Right.
So they're just going to grow at much lower margins. Okay. Versus the other story is they're going to kind of maintain their margins, but they're going to struggle with growth. So that's the original. If you have a negative 3% G, what you're saying is they're struggling with growth, but they're still going to maintain their margins. Your story is they're going to grow, but they're going to grow much lower margins. And their margins are actually going to be low enough that they're not going to earn their cost of capital. Now, because we're talking about the future, both stories are potentially true, but that would be the point. If you went this other path, you would have to explain that. Okay. So you can't just say 3%, 6% ROE, because that's the way the math works. You have to come up with a story and the context for why the math would work, given what you say is happening in the real world. And what I'm telling you is it's not an impossible story. Right. And then it's just a question of which one do you think is more likely? Personally, I think that the growth story is more troubled than the margin story, but it doesn't mean you can't argue the other side. But that's what you would have to argue. Does that make sense, Brian?
Yeah. How would you differentiate this from the Delta case? I remember Delta also had a negative G, a positive spread that they were growing at a negative G.
Well, this is why we do EICs, because tariffs aside, going into the beginning of this year, everything that you read in those industry reports should have told you that this is still a golden age of travel. All right, there's a lot of travel expectations around the world, and all of the airlines expected a lot of growth. That's why they're spending so much money on premium economy and first class and trying to make the experience a little less miserable than it used to be over the last few years, because they're seeing growth. And that's the whole idea, is that's why Boeing and Airbus have been so backlogged with their jets historically, is because there's a lot of growth in the airline industry. And so when you looked at Delta's negative 10% G, it was just in stark contrast to everything we knew about what was happening to the size of the pot, to the marketplace. And Delta, as probably one of the best airlines, like, a lot of things would have to go awry for Delta to continue to shrink out of existence in that market, or that market would have to dramatically change. So there was just some cognitive dissonance with Delta about that negative 10% growth, because when you start to see those numbers of negative 10%, that's a company in trouble. Because like I said, if you're losing 10% of your revenue and profits a year, you're gone in 10 years. And I don't think anybody thinks that the major airlines are going to be gone in 10 years. So it was just harder to explain that story, even though you can make math demonstrate that story could work. Whereas in this story, we're talking about negative 3% growth. I think that's a more explainable story. Because if you're at, I don't know how big Target is in revenue. Let's go look. It's TGT, US equity, yeah, with a proxy. But, Target's revenue is 104 billion, 105 billion. Even in the next few years, they're expected to grow to 116. So, we're talking about shrinking 3% a year. So they're at 116, 112, 107, 106, 105, 100, whatever. Like, could Target be like an 80, $90 billion long term? That could happen. A lot would have to go wrong. But that's an explainable story. It's also an explainable story that they could keep growing at 2 or 3% a year. But then these margins are going to have to collapse. They're pretty much going to have to become half of what they used to be, which is another way of saying that Target's probably oversold at this price. Like, this is probably not a good long-term valuation timing for Target, because they're part of the baby with the bathwater in this tariff roller coaster that we're on, that is getting smacked around while we're trying to figure out these valuations. But I'm telling you, both stories could potentially happen, and I think within a reasonable bounds. So that's why, and I don't know if I made this comment this semester, but I have in the past, that valuation is more art than science sometimes. Meaning, there's math. You got to be able to do the math, and I'm teaching you the math, right? And that's what you learn in, for example, other valuation classes. You learn how to do a DCF, right? You learn how to calculate the formulas, but that's not the whole part of it. It's, what assumptions do you put in? Like, that is much more important than the math. And unfortunately, the short answer is it depends. There's always context for what you do, because the future is not 100% certain. And we can't always look at the past as a guide. And that's why I'm making you, for example, do bulls and bears, because you have to think in the future that there could be different things that could happen, and what could happen with the business. You can't just be linear in all of your thinking. But when you're doing the bull and the bear, you got to ask yourself, is what I'm doing reasonable? And that's why I like the idea that part number 2 is finance is storytelling. Like, can you tell a story in your numbers, whether it's valuation, whether it's financial statement analysis? Like, that's the skill set. Like, if you're working in a real world company, you're doing a quarterly business review of what happened for your company for the last 3 quarters, that's going to be presented for any public company to senior leadership. Like, they're not going to just want to see that there was a 10% difference in the variance between the plan and the forecast. First question is going to be, why? Why were you so far off? And the second question is going to be, what are we going to do to get back on track? That's a real world quarterly business review. And they're going to expect answers to those questions. And if your answer is, well, it went down 10% because it went down 10%, then you're not going to last very long at any company. So that's the whole point. Finance is a lot more storytelling. You got to make sense of the numbers as opposed to just the numbers. So that's what I'm kind of forcing you guys to do here. That's why I want you to write the papers, because I can't tell you that you're wrong, but if you can't tell a reasonable story about why you put the assumptions in, then that's not credible. Long answer to your question, but does that kind of help directionally what we're doing here?
Yes, thank you.
So if I were Ashley and I were grading your paper, and I see Ashley is listening on this call, what I would be doing is I would be saying, if you put these numbers in, 3 and -6, does the story support that? Like, that would be the way that I could potentially give you credit. But if you didn't have a supporting contextual story that supported that made sense, then I wouldn't give you credit for that part of the reason for the premium or discount. And that's going to be true in any of the assignments. Let's check the chat for a second. Here. Tariffs. Somebody mentioned tariffs play a big part of this. And what happens with tariffs is going to have a big impact on these companies as well, because they're sourcing a lot of material from China, for example. All right, but back to explaining. Got to explain the premiums or discounts. I'm going to go back to my original numbers. Target's trading at a discount. Got to have an explanation. So that's PE, price to earnings. Then we'll come over here to EV to EBIT. So your second ratio is EV to EBIT. And you might say, well, gee, why are these ratios sometimes slightly differently than the ones on the PE tab? And just remember that EBIT and PE are different, meaning PE is based on net income, earnings per share, right? And if you remember, I told you that part of the reason why we prefer the enterprise value multiples is they tend to focus on the operations of the business, right? EBIT, right? Because it's revenue minus cost of goods sold minus SG&A and or depreciation, depending on whether it's plugged into cost of goods sold or broken out. But the point is, it's your operating expenses. And that's what EV to EBIT looks like. PE says, keep going. You got capital structure, you got one-time charges, you got tax rates. So there's other factors that can affect the PE. And that's why you can actually see sometimes differences between your multiples in PE and your multiples in EV to EBIT. Because one is based on capital structure. And so capital structure can play a big difference in PEs. So for example, you can get a high return on equity because you have mostly debt financing your business at 3 or 4%. And so therefore you can leverage it out with a high leverage ratio to squeeze out a very high ROE, right? Doesn't mean you're doing well. It just means that you've levered the heck out of your firm so that any profit gets amplified. Well, the opposite is true. When you start losing money, any loss gets amplified. So you're a much more risky firm. But nonetheless, PEs can be distorted by cap structure. EV to EBIT, cap structure is not part of EBIT. So therefore, they tend to be a little less distorted over time. And that's why, preferably, we like EV to EBIT over PE. But they can be different because this is more of an operating ratio, right? So with that in mind, Costco versus Walmart, Costco's EV to EBIT is 36, which is actually still pretty high. Walmart 23. So Costco's trading at a premium to Walmart. Now the difference is in the rearranged formula, there's 4 drivers here, which we've included the idea of tax rate. Okay, so we'll start with that. Tax rate between Costco and Walmart, not all that different. 26% at Costco, 24% at Walmart. That does favor Walmart. So that 2-point less tax rate should give Walmart a slightly better multiple. But you could even do some what ifs here and say, well, you know, if Costco was at 24%, how much of a change would that be? Not much. Okay, about a 1-point EV to EBIT. So it does impact it, but not dramatically. That's not explaining most of the difference, but nonetheless, Walmart does benefit and Costco has a little bit of a headwind because of a slightly higher tax rate. So why is Costco trading at such a premium? Well, same concept as PE, they got a much higher spread. 28% ROIC operating against an 8.4% expected WACC. I mean, that's a 20-point spread. Walmart, 13.7 operating ROIC against an 8-point WACC. That's only about a 6-point, rounding off 6-point spread. So much, much higher operating spread at Costco. And Costco, remember compounding, that extra 0.65% growth, 6.85 versus 6.2, that matters. So they're growing at almost 7% a year, much higher spread. That's why they have such a high EV to EBIT, and that's why they're trading at a premium. The WACCs are not all that different, but the WACC is a little bit of a benefit to Walmart. They're a little bit less risky than Costco, with 40 basis points. So that does favor Walmart. So Walmart is favored on WACC and tax rate, but that's not enough to offset the high growth, high spread of Costco. And that's why Costco's is a premium, 36 versus the 23 at EV to EBIT at Walmart. The Target has a very low EV to EBIT. Okay. And kind of this gets back to the same story we were talking about on the last slide. What's going on with Target? Right now, on an operating basis, the market expects the operating ROIC to be the lowest of the three companies, much lower than Costco, 12% versus 28%. Now, Target on an operating basis is a little bit more predictable, 7.2% WACC versus 7.4%, so that's benefiting them. But they just lack growth, negative 1% operating growth. So again, back to take revenue, drop it 1% per year. The market just doesn't see a lot of growth opportunities for Target and at lower returns than Walmart and Costco. And that's why they're trading at a discount, despite the fact that they have the lower WACC. Right now, we could have gone the other way and we could have probably put in a 1 or 2% growth rate. But either way, what you'd see is 1 or 2% growth rate, you'd have to explain the negative spread. Okay. Now that's going to be tougher when you get to the EV to sales multiple, which we'll do next, because you'd have to explain why that 5.3% operating margin is going to collapse long term. If you went the growth rate and if you killed the ROIC, that's what you'd have to be arguing, is that that number would have to go way down. Okay. I'm not saying it's not possible, but if Target's the premium brand, right? They have all those partnerships from Martha Stewart to Rachel Ray and everybody else. I think they're about 1/3 of their business is kind of these private labeling that they're partnering with people with. Basically, that's giving them better margins than the Costco's and the Walmarts. It's not their strategy, and it's not the expectation. So I personally think, that's what I said, I think that the premium brand strategy, premium discount retail, it's almost like an oxymoron. I think right now the market's worried about their ability to grow in that environment. So probably some short-term thinking by the market, but regardless, could put that in my bull and my bear if I were doing this. But regardless, that's why I think the negative 1% G probably makes more sense in this example, but it's also why they have such a low EV to EBIT. The market's just not giving them credit for long-term growth at lower spreads. Why do they have a lower spread? Well, I consider it EV to sales. People are only paying 52 cents per dollar of value for every dollar of revenue versus $1.41 at Costco. So Costco is trading at a premium there. Why? Well, Costco's got the lower margins, 3.9% versus Target at 5.3%. But the interesting thing about Target, they're the least efficient of the three firms. You're spending 3 times the capital, 33 cents per dollar, to sell the same products or similar products as Costco, who's spending 10 cents per dollar in capital. So the problem that Target's having is, even though they have the highest margins at 5%, because their productivity is much worse than Costco's, their expected return is only 12%. Because remember, margin times productivity is ROI. And so even though they have high margins, they're spending a lot more to make those margins. So that makes those sales and revenue much less attractive. And so that's what's going on with Target. That's why their returns are lower. And that's why people aren't paying a lot for the sales, because they know they're going to have to take some of those margins and plow it back into spending, whether it's the stores or infrastructure, wherever they're spending on. They're spending a lot more than Costco, and even more than Walmart right now, who's got a 0.26 productivity. You know, why is Costco more valued in EV to sales than Walmart? Well, again, Costco has lower margins than Walmart, 3.9 versus 4.6. But Walmart, again, productivity much worse than Costco, 0.26 versus 0.1. Walmart is spending 1.6 times the amount of investment that Costco is to sell similar products. And so that's giving Walmart a lower return on investment, 13.7% long-term versus Costco's 28% long-term. And so it's the efficiency of these margins is why people are paying so much for their sales. So that's homework 12. Somewhere in there is about what you should have been writing up. Questions? right? That's home we're told. Now, what's important that we did is this ROIC and this ROE is a perpetuity value, which means it's from today forever. So that is the long-term, starting today, average ROE. As the long-term, starting today, average ROE. That was one of the other issues that we ran into at Delta. Like when we did a DCF of Delta, problem was we made an assumption when we built our DCF model that year 6 was the perpetuity period. Okay. So essentially, sorry, back to the sharing, back to the Excel. This is the perpetuity. This is the perpetuity. So we're assuming that's long. Today represents the long term. Okay. The question is, what if today doesn't represent the long term? And that's what I was saying. Like when we did Delta, we're saying wherever we ended up in year 6 in our DCF, that's what they make forever. And the problem we were starting to run into is it wasn't worth that we're going to make forever. Okay. And so that's where this becomes a little bit more of a challenge, because I chose Costco, Walmart, and Target for our first assignment because today kind of looks like tomorrow for these firms. Like these discount retailers over the last 20 years have been pretty stable, plus or minus a little bit, but they haven't had dramatic swings. It's not like a roller coaster where they make 20% one year and 3% the other. They're not cyclical boom bust businesses. They're pretty stable. They do okay in good times. They do okay in bad times, kind of like grocery stores. They don't really change. Right? That's not going to be the case for every business. Caterpillar. Okay. Caterpillar is going to be boom and bust. Okay. In recessions, people don't buy as much equipment. In expansions, they buy more equipment. So Caterpillar is going to have a boom and bust cycle, which is going to look more like a sine. Right. And so the whole point here in my drawing on a whiteboard, if I can, is if we think about, sorry, you can see my poor drawing skills. Does the business look like this? Or does the business kind of look like it's supposed to be sine wave? That, right? The problem is, where do we go into perpetuity? Right? If we go into perpetuity here for a cyclical business, and what we're saying is that's the future, which means we miss these dips and we overvalue the company. If we go into perpetuity here for a business, then we miss these mountains and we undervalue the business. And so that's the big issue with multiples. And that's the big issue with continuing value and valuation is what's the representative perpetuity period? Because what you want is you want this kind of middle point. You want a midpoint. Whatever the long-term midpoint is really what you want to put in the perpetuity. So that's why growth businesses are actually very hard to do valuations on, because you're trying to balance out the growth with the mature long-term stage, and where do they end up, right? Mature firms are easy. If you got a firm that's growing at 2 to 3% a year consistently, they're relatively easy to value because it's easy to grow 2 to 3%, and you don't really have midpoints. But if you have businesses that are going up and down all the time, they're actually much harder to value. So these 3 firms were easier to value. For your next assignment, I'm going to give you somebody that's harder to value. and deal with this. But what I want you to think about is whatever data you put in, you're going to have to put in a reasonable number for the long term. So for your next industry, we're going to go to defense and aerospace. This is going to be your stop whiteboard. So let's say that one of your companies for next week, homework 13, is BMGT, which is Lockheed Martin. And you go to your EEO and you get your data in the Bloomberg lab for your Monday assignment. You come down here and you look at these return on equities. 81%, 96, 95, 92, 78. Why are these return on equities so high? How do you get to be a 96% return on equity? Just mathematically. Your profit divided by equity. How do you get to 96%? You either have to have a lot of profit or you have to have very little equity. Well, that's almost like an oxymoron, because if you have a lot of profit, should you have a lot of equity? So what's going on here? FA. If I look at Lockheed Martin's actual balance sheet, come down to the equity section of their balance sheet. Do you see this line? Other equity, negative 15 billion, negative 16 billion, negative 8 billion. And you look at the total equity, which is so tiny, given the size of the company. Why do they have so many liabilities and so little equity? Now, what is this other equity that's negative? Does anybody know what's going on here? Got some accountants on the phone. You counting people? What's going on? How do you end up with such little equity for a big company?
Are they privately owned?
That's a publicly traded company based in Bethesda, right down the road from us. Well, what's happening is even though it says treasury stock of 0, they've been buying back a lot of stock and it's showing up as this other equity account. So these are mostly share repurchases. So the problem is what ends up happening with these big companies is they will buy back a lot of stock. And on the accounting statements, we know this from our CFIs and TFIs, that when you buy back stock, it reduces equity. Well, if you reduce your equity, profit divided by reduced equity is very high return on equity, right? And that doesn't mean you're earning great returns. It just means that you don't have much equity in your business because you kind of paid it all back. And it kind of distorts the return on equity. Matter of fact, you can actually see a point where the return on equity goes negative. You could actually have a company with a negative return on equity. And then you have to ask yourself, why is a return on equity negative? Is it because their profit's negative? And what you'll see is the profit for a company might be positive, yet they have a negative ROE. And the answer is because they wiped out their equity because they bought it all back at market prices. So they essentially virtually have no equity on their balance sheet, even though they're making a profit, right? So you gotta be careful when you start to see these, what I'll call distorted return on equities. Because if you look at Lockheed Martin's ROIC, it's reasonably high. but it's not 90%. On an operating ROIC basis, it's closer to 26%, which is still high for the industry. But how do you get from a 26% ROIC to a 90% ROE? Well, that means your leverage ratio is like 3-to-1, right? Which means you're essentially 75% debt and 25% equity. Okay, you got to be ultra leveraged. Well, if you look at the WACC, they're 83% equity and 16% debt. So something's going on here with the math. And this is what I mean by distortion, because the distortion is that essentially they've been buying back a lot of stock. So translation, back to the whiteboard. All right. I'm oversimplifying here. Profit divided by invested capital profit. Now the profits once no patent net income. So I'm using proxies here. This is based on net income. That's based on no patent. Profit divided by my trackpad. Profit divided by equity. This is ROE. This is ROIC. So a little algebra. If you take profit over invested capital and multiply by invested capital over equity, it's your leverage ratio, you get ROE. So these two ratios are correlated. ROIC and ROE have to be correlated. And they're correlated by cap structure. Okay? Your invested capital to equity ratio. So basically, what is invested capital? Oversimplifying, it's debt plus equity divided by equity. That's basically an oversimplified version of invested capital. So that's the whole point. How much debt and equity, that mix, that leverage ratio, levers up the price to earnings ratio, okay? Levers up the return on equity. So leverage matters in this equation. Now, in a way, you can kind of distort the leverage by either adding a lot of debt, or you can buy back all your stock and get rid of the equity, which means you're just left with debt. But either way, you have more debt relative to equity. But at the end of the day, these two ratios should be correlated. So translation, every now and then, you're going to see a company where you're going to get an extreme ROE and an ROIC that are not tied together. And you're going to have to try and reconcile it when you do your multiple analysis. So last semester, the TAs came up with a little worksheet based on this to help you. And that file, close out this one, is here on ALPS. It's in the files folder. And I just uploaded it today, and it's called Homework Help. And if you download this file, what it really does is it's got two tabs. And one tab says, if you know the ROIC, you can put in the debt to equity ratio, and it will estimate what the long-term ROE would be. Tab number 2 says, if you know the ROE, you can put the debt to equity ratio in, and it'll estimate the long-term ROIC. So when you run into trouble coming up with a long-term ROIC and ROE that match, like a Lockheed Martin, which one is more reasonable? Do you think it's a 98% return on equity or a 26% ROIC? I think the 26% ROIC is more reasonable. So what you do is you create almost like a synthetic return on equity and say, well, they've been distorting their balance sheet because they've been buying back a lot of stock. So the real return on equity is take 26% ROIC, put in the debt to equity ratio, and come up with an ROE. Use that ROE in your Excel model when you're trying to explain the premiums or differences in the multiples, as opposed to putting in 96%, which may not be as explainable. So when you see distorted numbers that don't match, you can actually match them. Or when you see a company that doesn't make any money, you can say, okay, well, if they eventually made money, here's what their ROIC and ROE should be given these multiples. So in this next assignment, you may need to use this template to tie your ROICs and ROEs together so that they are more explainable for the model. And so I'm going to give you 3 companies to work on. And I will warn you in advance that these are going to be more difficult to do. It's not difficult to get the data, but that you're going to have to question, like, where are these companies in the cycle? And is the perpetuity really representative? And are those ROEs and ROICs kind of correlated in sync that I'm seeing from the data? One of the companies is Lockheed Martin. The other company that I'm going to give you that might be a challenge is called RTX. And if I look at RTX, defense and aerospace company, but half their business is defense and half their business is commercial airlines. RTX is one of the biggest suppliers to Boeing. They make most of the parts for the 737 MAX. They also make missiles and defense radar systems. So half their business defense, half their business commercial. Lockheed Martin, almost all their business is defense. Guys, just a little hint about what's going to go on in the 2 companies. But when you look at these earnings estimates for RTX, what you're also going to see is they're not doing so well today in an ROE and expected to do better over time. So you got to think about where the perpetuity is. What's the long-term performance of this business? Okay. So just FYI, then how does that tie in to our ROIC? Because the ROIC of today probably is not the perpetuity ROIC. So for example, if I go to the RV, last year, the operating ROIC of RTX is please. 7.6, which is basically a 0 spread. And I'm telling you that their multiples, which are 16 PE and a 15 EV to EBIT, or sorry, 18 PE and a 16.5 EV to EBIT, with those ROICs and that current ROE, you're not going to get there with a key value driver model. So for RTX, the long term that the market's using for these multiples is not what happened in 2023. So when we did Costco, Target, and Walmart, 2024 kind of looked like 2030 in perpetuity. That's not going to be the case for some of these defense companies. So you're going to have to figure out what is a reasonable long term that explains these. And if you calculate one number, like here's what I think the reasonable ROE should be, I can estimate what the reasonable ROIC should be based on that. if I estimate what the ROIC should be, here's what the estimated ROE should be on that number. They should be correlated. Okay, so there's a little more estimation here and explanation of how you got to that. So your three companies are Lockheed Martin, RTX, and Leidos. Those are the three companies I want you to do the multiple analysis for homework 13. I'm about to update it. If you're in the lab, you can start getting the data today. You have the templates based on homework 12. You'll get that data. But I'm letting you know it's going to be a little less straightforward than the last one, even though it's a similar process. There's just going to be more work up front and coming up with reasonable solutions. TAs have office hours the next 2 days. Take advantage of that. Take advantage of the spreadsheet that I just gave you. If you have any questions, let us know. Anything else before we end our class today?
There was a question on whether we should submit screenshots for homework 13.
Yes, got to give screenshots. And if you make adjustments to the screenshots, you got to explain them in your papers. But there will always be screenshots. I gave you the ones for homework 12 because it was Easter, and I already knew from the flood of emails I was getting that everybody was asking for extensions. So I kind of nipped that one in the bud by making it easy for everybody. I gave you screenshots. Homework 13, you got to get all the screenshots yourself. Those are three companies. I'm updating the assignment now. This video will be posted very shortly. Good luck. See you guys on Monday. Have a good rest of your week.